This is our Forex blog for May 5th, 2011, and like most days, we really want to trade the strongest pairs versus the weakest. The yen was in a downtrend, but over the last 2 days, shifted back up. The monthly trend's just slightly up, the weekly trend's up, the daily trend's up, and you can see just incredible real-time strength today in the yen. So you really want to trade that currency against one of the weaker ones. The CAD, daily, weekly, monthly trends down, the New Zealand down, the pound slightly down. So any of these three here on the right, and including the Australian, because the weekly trend's down, if you have to pick between the weekly and the monthly trend, because we're intraday traders looking for 20 to 50 pip moves, I find the weekly trend to be more predictive than the monthly trend. So you have these three pairs right here you could have traded against a very strong yen. Now clearly coming into 1 o'clock right here, the CAD was weaker than the pound, weaker than the New Zealand, and a little bit weaker than the Australian. So selling the CAD yen would have been a very smart thing to do coming, starting today off. You can see the prices underneath the hourly moving average. We had a narrow range 7 inside bar right here on a 4-hour bar. And typically when the markets are in very narrow ranges and they break out, you tend to get some trends. So you might have gone short, if you traded the Asian session last night, short here, small loss. You might have got a stop with a small loss here, and you maybe made 20 pips on that third trade. But once the market went sideways and broke down underneath this fib level, the CAD was one of the weakest pairs and the yen was one of the strongest ones. And here's your next profit target level. So next support level, and it's also a Fibonacci profit target level, and then this is the next one. Most days when the market's underneath the lower band, if you see a Fibonacci profit target that I draw each night on the charts, that's usually going to be the end of the move. In this case, it was the second Fibonacci profit target that was, ultimately hit. I'm going to take off the Trend Intensity Pro. This measures extreme strength or weakness, and anytime you get a plus 20 or minus 20 reading, typically those trends continue. So when it hit minus 20 right here, and the market went sideways and eventually broke down about an hour later, all hell broke loose to the downside. And our tipping point measures the mass of the market. What percentage of CAD pairs are going up or down, and yen pairs, the same. FX tipping point, and the Momentum Pro measures how rapidly these currencies are going up or down. So last night, let's say you decided to sell the breakdown right here. First of all, there's decent mass to the market. Very high percentage of CAD pairs are going down, yen pairs are going up. But when it breaks down right here, there's not a whole lot of momentum. So right away you knew the odds of this trade working was very small. It did go down 10 pips. It's at the lower containment band. We got major support right underneath here. Monthly pivot, previous day's low. And with the exception of this one bar right here, the next bar, even though this pair didn't go above its previous bar's high, you can see other ones going up with decent momentum. So you actually could have got out of this trade with just a 2 or 3 pip loss, or even a break even or small win. And the same thing happened later on when it broke down. Good mass to the market, decent velocity to the downside, and as it's going sideways right here, notice the mass of the market falling off and the velocity of the downside falling off. You had a very small, maybe 6 or 7 pip profit in here, and you got to get out. Now, a lot of times the market, after being in a narrow range, comes back into the range and breaks down a little bit later. You might have went short right here. Keep in mind the Fibonacci profit retracement levels right here. And initially there's some decent mass and velocity. And then, as you can see right here, it's not going lower. It's at the previous day's low, major support level. And, the velocity of the downside's ended. So, a lot of times the big move doesn't happen right away, but with these tools you can take out 5, 10, 12 pips sometimes, right? Pulls back up, doesn't break this high here, starts to go back down. You might have gone short again right here. The mass is okay, decent velocity. It comes down, and then you can see it just kind of dries up down there. So at the very minimum, you'd exit half your trade and maybe put your stop above the bar's high here. But when it did eventually drop and break the lows here, notice very high percentage CAD pairs going down, yen pairs going up, initially with a lot of momentum. Then the velocity of the downside dries up. You can tighten your stop above these sideways bars, and then it never stops you out and just keeps going. Mass and velocity equal big moves, and when both of these are at or above the white line, typically you're going to make a lot of money on your trades. Later today, up near the highs. The euro was strong, and earlier today the dollar was weak. You know, the weekly trend's down, monthly trend's down. It had quite a bit of weakness until about 4, where the dollar became extremely strong. Let's look at the euro dollar right here. From midnight to 4, if you focus on buys, especially once it was above the hourly, you didn't make much. And you can see the trend intensity pro did not show incredible strength. Notice right here, incredible weakness. That trend continued. We're going to put the tipping point on here to let you see how this would have helped you realize the euro dollar was not likely to go up, was very likely to go down, and once it started to go down, how these tools would have kept you into the trade. You know, which is the main thing. You never know, at least I never knew before these tools, what my odds were of getting a big move, you know, or is the likelihood of only having a small profit. Notice as this thing was going up, there was decent mass to some of these moves, very briefly for a bar or two. But for the most part, with the exception of before midnight, less than average volatility, you know, with the exception of a few bars. Once this, you know, failed to break out above the previous week's high, which is a major resistance area coming up to it, and once it breaks, that's very bullish. It comes back down right here and doesn't make a higher high and double tops right there and starts to break down. A lot of traders would sell the double top up there. Sorry, I thought I was going to sneeze, but never did. So initially, as it starts coming down, there's, you know, decent percentage euro pairs falling, dollar pairs getting stronger. On occasion, there's a bar with a lot of momentum, and once it breaks underneath the hourly, it's more likely to go down. When it's above the hourly, it's more likely to go up. So if you shorted right here, initially you're expecting this or the weekly pivot level right here to be your, you know, profit target. You might have gone short here at 82, expecting 51 to be your profit target. It broke there. There's a lot of counter trend buy signals, and once the downwards momentum, the tipping point starts, you know, going from extreme levels to average levels, you might have got out of half your trade there, or even the whole thing as it went sideways. You can always sell it again when it breaks down. So you got short right here, decent mass and velocity. On that one little bar where it went up, there wasn't that high of a percentage of euro pairs that went up compared to before, and compared to the weakness on the way down. So your stop above the bar's sideways rectangle high, you know, does not get hit. And as it starts coming down again, look, almost every euro pair is weak, dollar pair is strong, and it's got more than 3 times volatility for this bar. Obviously, this is a news release, phenomenal push to the downside. You're already in the trade before. Everything was showing it was more likely to go down than up. And even if you got out of it underneath the lower containment band right here at one of our trading zones at 88, you made 110 pips or so. Now, normally it's very risky to sell way underneath the lower band, and most of the time you're not going to. In fact, this time on the way up, there was pretty decent euro pairs going up, dollar pairs going down with decent momentum. I don't think I would have sold there. But the second time, where it made it a little bit lower low and pulled back a little bit, you can see not nearly as much strength as before, less than an extreme level of strength. This is a much safer short right here, and you don't know when it's this far underneath the band, lower containment band, where it's going to go. But if you're short and you start seeing the tipping point hit extreme levels with high momentum, you know, maybe you get out of this trade right here with 30 or 40 pips, or you tighten your stop, because it's very likely to reverse at some point when it's this far underneath the lower band. I don't think I would have taken this trade here because of the extreme strength. Maybe you might have jumped on board it once you saw this incredible weakness right here. You would have got in a little bit later than I would have liked. But when almost every euro pair is going down, dollar pair is getting stronger with you know, a much above average extreme reading. Anything at the white level or higher is an extreme level. You could have got in a little bit earlier. And there's no reason really to get out because there's no signs of strength. Usually when markets make these kind of big moves, you can draw your fibs on there, and the fib target's right down there, and that's pretty much where it went to. That's the maximum likely profit target. Now the Swiss, very strong weekly monthly trend. You can see it had a lot of strength earlier, and the intensity of that strength kind of got less and less. You know, it's kind of a lot riskier to look for sells in a currency that's this strong. You know, so you're better off trading that weak euro. And the euro was the weakest at the time. The Swiss was also strong, but let's say you decided to take what in the past has been a risky trade by selling the dollar. I'm sorry, by buying the strong dollar against a weak Swiss. These new tools allow you to take those trades and pretty much relatively quickly into the trade know whether it's going to work or not. First of all, notice the narrow range pattern right here. Once it broke underneath there, stayed underneath there, we had a nice trend down, and you always want to draw your fib targets on the first wave, and usually between the first and second fib target, that's where it's going to end. Notice extreme weakness here, the double bottom right here with almost no weakness. Counter trend traders trying to buy the fib target, especially with our new tools, could have got into that upwards trend really early, right near the lows. So first I'm going to take off the Trend Intensity Pro, and then we're going to put on the Tipping Point and Momentum Pro, and let you see how this really helps you not only buy bottoms with a much higher degree of probability and much less risk, because you can more quickly get out of them when they don't work. If you don't see some strength coming in a real-time basis, you get the hell out of it. If you're up 3 or 4 pips, you make 3 or 4 pips. If you're down 4 pips, you don't lose much. So let's look at that on the first part of this. As it was coming down here, initially quite a bit of weakness, tipping point, okay, right here, weakness, and then all of a sudden the weakness is gone. It rallies up with okay tipping point, not much momentum, and thus that upwards move fails, comes back down, and the tipping point on the first bar is very weak, momentum is weak, and then down here near the double bottom, the tipping point goes under the extreme level, and there's no momentum to the downside. The velocity of the down move is over. So if you want to try to buy this 1, 2, 3 low, when you have most markets reverse on either double bottoms or double tops or 1, 2, 3 patterns. This is a 1, 2, 3 pattern where it makes a low, rallies up, and then usually retraces no more than 62% of the way down. That's my mathematical definition of this. And notice where it went, right to the 62%. And you can pretty easily spot them. Usually they pull back about 50% of it and don't go below it. And you want to buy a 1, 2, 3 pattern when it breaks out above those bars high. And like I said, pretty early into the trade on the first bar, once it broke out right here and had very high tipping point, which means most of the dollar pairs are going up, Swiss pairs are going down, and there's decent momentum behind it. And your stop would be just underneath the low here. You're not even risking 10 pips. And most of the time, counter trend trades will work their way back up to the hourly. So you have a profit target up here at 95, you're in at 70. You're going to risk, less than 10 pips with a pretty good, decent odds most times of getting 25 pips. And that's really the secret to trading. You can, with a 2.5 times bigger win to loss, you can be wrong a lot more than you are right and still make money. And that's the whole benefit behind it. So once you're in this trade and it starts going up, decent tipping point, the momentum's kind of slowing up. You might have got out of half your trade right here at the hourly, with maybe 20 pips on the first half. Move your stop up underneath these lows. And most of the time, it's not just going to explode through the hourly right here. So, kind of watch the tools in real time, and you got stopped out there. You made maybe 20 pips on that trade. But the momentum is to the upside. If you're looking to sell that, you might not do it. Now, look, it's breaking above the hourly here. Let's say you decide to buy here 20 minutes after you got out of your first buy's exit. Tipping point isn't that strong, but the momentum to the upside is very high. So you would put your stop underneath the bar's low. You might have been long here at 95, 96. You have less than a 10 pip stop again. And guess what? Tipping point and momentum is dried up. It's really 50-50 now whether you're going to get stopped out with a small loss or not. If it starts going back up again and you don't see massive tipping point and momentum come in, you want to get out. I'd also personally at this point, because it didn't take off immediately, it didn't quite stop us out either, I'm moving my stop up. So I'm going to lose 4 or 5 pips max here if I'm wrong. And that's how you minimize your average losses. And by using these tools, oftentimes, catch a nice 20, 30 pip move, which is bigger than your average loss. And that's really the only, key to trading. So as it starts going back up, these are all green, which means other dollar pairs are going up, Swiss pairs are going up. They're not going up that much as a percentage of past volatility for this bar. And boom, we get stopped out. Which is all right because, the daily, weekly, monthly trend of this currency is down. And it's a, more risky trade to buy in the middle like that. So now we'll wait and see if it takes out the high here. I'm not buying it again until it goes above this high. And I'm not buying a pullback underneath the hourly either. So we're not into that trade here. Alright, it pulled back, went up, pulled back. If it doesn't break this low, you might consider, buying it, because the previous momentum was to the upside. If you did sell it right here, notice extreme weakness, which then all of a sudden got replaced with extreme strength, so you'd have to get out of that trade with a small profit. Now you have very high tipping point without that much momentum. It's always risky to buy right underneath the hourly though, but let's say we decided to do that right here. Some of the rules that I've followed for 10 years, the tipping point is actually making them kind of obsolete now, because there's certain rules we followed in the past to avoid unnecessary losses. But now with a tipping point, you can take a trade like this, even though it's risky and not likely to go above the hourly right here. And if you're in the trade and you see tipping point and the mass and velocity explode to the upside, you stay with it, and if not, you exit it with a small loss. Notice tipping point and the momentum is increasing. At this point, because you're buying underneath the hourly and it's a risky trade, I might move my stop a few pips underneath the low. I'm going to lose no more than 4 pips here. And if I'm right and it explodes up, I'm going to make a lot more than that. Boom, explodes up. It's above the hourly. It's very likely to go above this high because almost all the dollar pairs are going up, Swiss pairs are going down, and the momentum is 189% of normal. So I probably would have get out of half the trade here because it's not continuing, because it was a risky trade, and I'll move my stop underneath here. And a lot of times what I'm doing now is I'm buying the breakout of the high again. If it breaks back above the high here, because of the explosive nature of that move up, very little momentum to the downside. If it goes above the high, whatever I got out of half my trade, I'm adding it back right here. And just explosive to the upside, mass and velocity. After a big bar like this, typically you have a bar or two sideways, and you might want to get out of half your trade if it doesn't go higher. Alright, went higher. That's very rare. Usually after an explosive bar like this, you kind of have some sideways action. So I'd be out of half my trade here at 86. 26 pips on half. We're in the first trade down here at 80, so we made 40 something pips. And this one's continuing up. Mass and velocity is there. Counter trend sell signal, it's at the upper containment band, very likely to reverse. 86.50 is coming up, which is the 50 and whole numbers tend to have major buying and selling at them. And more than likely I'm going to get out as soon as it starts breaking the lows, and it hasn't yet. So alright, I'm out of the trade up here of the second half at 53. Huge move, and most of the time above the upper containment band they don't continue. In this case it did. Again, if you wanted to take a trade, risky trade up here, you can, but if you don't see a lot of mass and velocity come in, first sign of it pulling back, you want to get out of your trade.